Okay, dear students, hope you are fine. And today we are doing pre-mock MTQ, right? Okay, so it's pre-mock December 2025, latest one, and it contains IAS 2 inventory valuation, and we have IFRS 9 in this up to some extent, and also IFRS 18. So it's very good for revision purpose. Be active. Hope you will understand everything. So D company is preparing its financial statement for the year ended 31st December X8 and has identified the following issues, right? In the draft, first of all, inventory. In the draft financial statement, D company's closing inventory right now it's 8.6. Right now it's 8.6 million. Okay. Product A, which cost the real cost of product A is 0.36 million, was incorrectly included in the balance at 0.63 million. Okay, this is the first mistake. First mistake. Let me correct it. Wait. Your SOFP valuation is right now it's 8.6. Okay, so they should have included this inventory at 0.36, but they did include at 0.63. So now very simple, that means 0.63 is wrong and 0.36 is correct. So what you will do, whatever wrong you have done, just simply remove it, and whatever the correct amount is, just simply add it. So you have included 0.36 wrong, just remove the wrong amount. Sorry, you have recorded at 0.63, which is wrong, so remove the 0.63 amount and the correct amount is 0.36. That's it. You have corrected this error. You have corrected this first error. That's it. Very simple. Use your brain. Now next thing, product B was included at its cost, already included at cost. However, it could only be sold for 50% of the normal selling price due to technological fault in one of the parts. This is for NRV. Denny company charges markup of 30% on product B. Now, first of all, calculate the selling price. Wait, this is the original cost. And this is the markup percentage. Original cost is 0.4 million and markup is 30%. Now wait. Let me recall you. You remember this SCP technique? In past you did it. This is dollar column, this is percentage column, right? So your cost is 0.4 million. In dollar column your cost is 0.4, and yes, you have markup given. In markup means profit percentage on cost. So in markup cost is always 100, profit is 30%, so it's going to be 130%. Okay, so now can anybody calculate the selling price? Yes, 0.4 is equivalent to 100, so 0.4 divided by 100 into 130. 0.4 divided by 100 into 130. So this will be, I think, this is 0.52. This is the normal selling price. Now use your brain. It is written, however, it could only be sold for 50% of the normal selling price. Now nowadays the real selling price is 50% of this. So 0.52 multiplied by 50% is 0.26. So this is your NRV. This is right now your NRV. Now wait. You have calculated the NRV. So IAS2 says keep two things. At one part write cost. The original cost is 0.4 and the NRV is 0.26. Now you tell me. You remember the dialogue, inventory should be recorded at lower of cost or NRV. Okay, so now what is the mistake? These foolish accountant recorded this inventory at cost, but in reality it should have been recorded at NRV. So I would say again, they recorded at 0.4, but it should have been recorded at 0.26. So no, don't use the complicated brain. Just simply remove the original 0.4 and add 0.26. Because 0.4 is the wrong amount, just remove it, and the correct amount is 0.26. So remove 0.4 and add 0.26. Finally, you will get the answer. Although you can do the net amount, as well, adjust net amount, but I'm teaching you with this simplified approach. It's going to be 8.19 million, okay? 8.19 million. What is the correct carrying amount of inventory at 30? This is the answer. First question done. First requirement done. Okay. Now let's move to the second requirement, which is very easy, and you have done many times in the final account. Even I teach this in final account many times. On 1st November X8, Dania factored, remember factoring, sold $2 million of trade receivable to capital company. Dania received an immediate payment of 1.8 million, right? So now you have to decide what is the game of bad debts. Who is bearing the risk of bad debt? Remember, insured and uninsured bad debt. Let's see. Under the factoring agreement, any receivables, open your eyes, any receivables not collected after 4 months will be sold back to Dania. That means we are responsible for the bad debt risk. So that means in reality, the real risk of bad debt, the real risk of receivable, that is bad debt, has not yet been transferred. So if the risk has not yet been transferred, that means it is not sold. In that case, this 1.8 million will be treated as a loan. So you need to make only one small entry: bank debit 1.8 and loan from factor credit 1.8. This is the entry which we need to make. Okay, now next. So which of the following reflect the correct accounting treatment of the factoring trade receivable? Now, and admin expenses, no, not at all. Admin expenses can only be booked. See, 2 million is the receivable amount, 1.8 million we receive. So if it would have been insured bad debts thing, then you can de-recognize the receivable and you can book the expense. But in this case, this is the story of uninsured bad debts. The receivable should be de-recognized. Never, not in this case. This represents a without recourse. No, this is with recourse. Without recourse is insured agreement, and with recourse is uninsured. Right now it's uninsured. The receipt of 1.8 million. Yes, this is perfect. Okay. Now, measurement of inventory at lower of cost or NRV. Which of the following qualitative characteristic? First of all, this is the application of prudence. Whenever we record inventory at lower of cost or cost and NRV, we are applying prudence concept. Okay. And what prudence concept says, that you cannot book future income now, and the losses should be booked immediately if condition exists. Okay. So wait. it has nothing to do with understandability. Hope you remember the understandability, that financial statement should be understandable up to some extent. So it has nothing to do with verifiability, it has nothing to do with timeliness. But yes, listen to me, when you are booking losses immediately, if there is a loss and you are booking it immediately, that means you are doing pure faithful representation, you are faithful to your shareholders, you are showing the real picture immediately, right? Okay. And one more thing, in prudence concept, you cannot book future income now, so this is again faithful representation, you are doing in the best interest of your shareholder. So it's very close to neutrality, and neutrality is one of the attributes, of faithful representation. So faithful representation is the most appropriate answer, and you can even think over it. Yes, hope you remember, there is a concept called substance over form, very famous concept. Yes, substance over form is also the application of prudence concept. Sorry, substance over form is also the attribute of faithful representation, because in substance over form you record the transaction on economic reality, not legality. Remember? So here the same thing. You are not booking future income now, so again you are favoring the shareholders. You are doing things faithfully. So 3 things done. Now 4th is very easy. You have done it many times, and that should be a mechanical work. I sometimes say a teacher should turn on the button and students should work like machine on this thing. Very easy. Convertible loan notes. Okay. Debt and equity. So D company issued 8%, 30 million. This is the principal receipts, and this 8% is coupon rate. Okay. So can you calculate physical interest? Yes. Face value into coupon rate. So 30 multiplied by 8% is 2.4. Every year this 2.4 million should be paid. Every year this 2.4 million should be paid. Interest is paid annually in arrears on 31st December. An equivalent loan without the conversion option would carry an interest rate of 10%. C. That means this is the market interest rate. If there would be no conversion option, then the interest rate would be 10%. So that means there is some equity option as well. See, there is why we accept. Just think, we are investors. Just treat yourself as an investor. So in the market, you are getting 10%, but this guy is giving you only 8%. So why did you accept? Because you are not investing in loan only. You are investing in equity also. So this is the evidence that there is an equity option available in this. Now, without the conversion option, okay, the loan notes are redeemable or convertible after 5 years at the option of the loan note holder. Okay, so hope you remember the 2 discount factors are given. So always cross this one. We do discounting at market interest rate. Okay, right? So let's do it now. How we used to do this in class? Very simple. First of all, treat the transaction as a pure loan. Treat this transaction as a pure loan and identify the cash flows. Plot the cash flows. So there will be 5 interest payment, and at the end of year 5 there is a principal payment. Okay, so how are you going to do it? It's going to be 2.4, 2.4, and 32.4. Okay, because at year 5 you will have principal plus interest. Now these are the cash flows. Okay, you will multiply it by discount factor. With the rate is 10%, so the discount factor is 0.91, 0.83, 0.75, 0.68, 0.62. Okay, now can you multiply it? 2.4 multiplied by 0.91. Okay, so add all these things plus it's going to be 27.048. Okay, this is the present value of liability element. This is a very routine work, honestly. There is a possibility you must have done this like 20 times. I'm telling you, 20, 15, 20 times. There are a lot of practice question for this in the class. Then you have final account, then you have MCQs, then you have MTQs. Okay, so this is the present. Now what is the initial cash? How much? See, the present value of the liability element is 27.048, but initially the investors gave us 30 million. So why investor gave us 30 million when the transaction, if the transaction is treated as a loan, it would have a present value of only 27.048. Why? Because the investor invested in one more thing, and that is equity option. So can you take the difference? Yes, this will be 2.952. This will be 2.952. 2.952. Let me add it. Oh, sorry. This is 0.62. See, this is the last one is 0.62, but I have written as 0.6. Okay, that's why there is a difference. Let me correct it. This one is 0.62. Okay, see these things, you guys can also do these mistakes. When I can do it, I can misread this 0.62. I have written it as 0.6, but in reality it is 0.62. Okay, so actually I'm taking the class without glasses, it's comfortable for me. 32.4 multiplied by 0.62, it's 20.088. Okay, $27.696. Now 2.304, right? 2.304, and if you remove this million sign, So it will be 2304,000, 2304,000. So now read it. What they are asking, what is the carrying amount of equity component? It's going to be this 2304,000. Easy question. 2304,000. Routine question. 2304,000. Are you getting? Okay, now last thing, IFRS 18. I would recommend you to read toward the class of IFRS 18 as well as read the study hub of IFRS 18 as well. It will be beneficial for you. Now, last thing, which of the following statement is incorrect? Incorrect according to IFRS 18. Okay, we need to pick the wrong statement. Entities are permitted to prepare financial statement for a period short. Yes, it is allowed. It's your wish. You can. Assets and liabilities should be aggregated. Yes, there is a very famous issue of this, aggregation and disaggregation. Aggregation and disaggregation. If the characteristics are same, you can aggregate. If the characteristics are not same, you should disaggregate. Yes. So assets and liabilities, I have given you in my class example of shirts, that you cannot hang a shirt and then a sock. No, it's not good match, but you can all bundle it up, all socks together, right? So assets and liabilities should be aggregated based on characteristics that are shared, yes, and disaggregated based on that are, yes, perfect. Assets and liabilities, income and expenses should not be offset unless another IFRS accounting standard or allows offsetting. This is also true. Wait, for example, you have a receivable of 100,000, you have a receivable of 100,000 and payable of 30,000 from the same person. So can you offset according to IFRS 18? The answer is IFRS 18 says I don't know. Ask the relevant standard. And here the relevant standard for receivable payable is IFRS 9. IFRS 9 financial instrument. Okay, so we'll go to IFRS 9, and if IFRS 9 has allowed us, then you can do it. I repeat, for example, there is income of 30 and expense of 10. So can we write simply 20 as a net income? Can we offset income or expense or asset or liabilities? Yes, you can. But IFRS 18 says it's not my area. It's not my domain. I won't say anything. Just go to the relevant standard. Just go to the relevant accounting standard. And if that relevant accounting standard has allowed you to offset, yes, do it. I won't say anything. Bring the visa. Bring the visa, I'll allow you. You get it? So this is correct. Third is correct. Now fourth, presenting trade receivable net of allowance for credit loss is an example. Allowance for credit loss means, for you guys, this is allowance for receivable. Remember in F3 FA level, allowance for receivable, this is like allowance for receivable. Wait. So presenting the trade receivable net of allowance for credit loss is an example of offsetting. No. See, the answer is here in the point number 3. Offsetting means assets and liabilities or income and expense. If you are cancelling asset and a liability, if you are netting off a asset or liability or income or expense, then it's offsetting. But here it is written receivable and allowance for receivable. So receivable is your asset, trade receivable is your asset, and this allowance for receivable is your contra asset, opposite to asset. But offsetting means you are cancelling asset and a liability or income or expense, but here you are going to cancel asset and a contra asset. So it's not offsetting at all. Right? Okay, so the answer is 4. This was the last one, was very good question. Very good question. Okay, so finally this question is done. We would request you to, if you like it, please comment it and share with your friends. And I would recommend you to read IFRS 18 if you have time, from article or from ACCA Study Hub. Okay, so that's it for today's class. Thank you and take care.